If you're struggling to trade well in the current market conditions, this video is going to help you all tremendously. How many of you recently have taken a trade that your stop loss triggers, you exit for a loss, and then a few minutes later the market moves in your favor and you could have made profits if you did not stop out for a loss? There's nothing more frustrating than that, and there's nothing more annoying than your analysis being correct, but you just mistimed the move. Now, in this video, I'm going to discuss the current market conditions. I like to call them the Trump market because honestly, not a lot of people have ever experienced this type of market, or they are beginner traders or new traders, and they don't understand how to trade in this volatility. Now, this tip or trick or tweak that I'm going to discuss in this video, I've implemented myself, and in February, I've made a gross profit of $179,000. And in March so far, I've made gross profit of $29,000 so far. I'm very confident if you all implemented the tweak that I'm going to show you in this video, you will start seeing a difference in your trading where you're taking better setups and you're going to be taking fewer losses. What we've seen so far is just larger ranges and a lot of volatile moves. Now, the real cause of this is that the order book has been very thin, which just means less volume is needed to move the market up or down sporadically. Now, I posted this on my Instagram recently, which is just being aware of the large ranges when the book is this thin, because it causes the market to move up or down very sporadically and in a violent way. When I say order book, I'm just referring to the level 2. A lot of people hear level 2, bid and offers, bid or ask. It's just passive buyers or passive sellers in this market. It's highlighted here in the green circles. The order book, which is a screenshot right now of the S&P 500, is relatively thinner, which causes less volume to move the market up or down. When the volume is high that day, this is when we get the larger ranges and the moves up and down very violently and sporadically. Now, what this is going to cause is traders to easily stop out of a position if the stop loss is too tight or lose on the wrong direction relatively fast. I posted this on my Instagram a few weeks ago. If you're watching this and you're not following me on there, I would definitely recommend to do so. I'm going to post a link in the description below. I just post daily trading recaps along with really important tips and tricks that I guarantee you're just not going to find anywhere else on the internet. Again, the link for this will be in the description below. It's just a good resource you're missing out on if you don't follow it. But because of how thin the order book has been, it's not uncommon for the market to rally or drop 30 plus points in a few minutes or even a few seconds, honestly. It's not uncommon for a 100-point day on the S&P 500 or a 500-point drop on the NASDAQ. This is very common in the recent market conditions. When the conditions change, we as traders have to follow suit and change with these conditions. Now, honestly, a lot of newer traders have not experienced such volatility. A lot of traders, if you've traded from 2020 on, have never experienced a Trump market. And in a Trump market, it's usually that a simple tweet or a simple tariff piece of headline, or in general, just the volatility increases and we get the sporadic large price movements. Now, really just narrowing this down within the past 2 or 3 weeks, as I'm recording this video on March 10th, I've pulled up an ATR indicator, which just simply shows the average true range, which in fancy terms is just the average range of that specific day on that instrument. So this blue line currently, the S&P 500 today has moved 170 points on a single day. This average true range has been recently uptrending while the market has been downtrending. Now, what this means is that the moves down have been in larger ranges, or violent moves down have been met with a lot of continuation, causing the range to increase as the market is selling off. So this large range, we have to trade a little differently and compensate or adjust our strategy to fit this volatility. Because if you do things you were doing 2-3 months ago, let's even say in September, October, November, look at the average range then. The average range was, 40 on the S&P, 60, 70. There really wasn't anything higher on multiple days above around 70 or 80, which I've just now highlighted by this white line. So the range was smaller in previous months compared to the range that we are seeing right now. And if I were to zoom out on this chart, you can compare the average range now to what it was in September, October, November, when it was significantly lower. So trading the same way that we traded in September, October, November is not going to be as effective as it is now in February, March, when the range is increasing and the market is aggressively moving up or specifically down in the current market. Now, if we're right on the market direction, a 100-point on the S&P, a 500-point sell-off on the NASDAQ is going to make somebody's year. But we have to think with a gain will come a loss. So on the defensive side, when we are wrong, we have to position ourselves that when we actually are incorrect, the losses are not going to be amplified, especially if the wins are not amplified. So what I recommend everybody doing, and what I have recently been doing, is just widening my stop loss. Now, it's not as simple as widening the stop loss and doing nothing else. When a stop loss is widened, or you have a larger stop loss relative to the entry, what's necessary to be done here is to lower the position size, but keep the risk consistent. Point A right here is extremely crucial to do this. It's not as simple as just widening your stop loss to brace for the volatility. Because if we trade with the same size as we normally do, and when we now widen our stop loss, if our stop loss hits, our losses are just going to be amplified. So when we widen our stop loss, we have to keep our risk consistent. What a wider stop loss means is that further out targets are very achievable. They're very likely. It's not unlikely to have a further out target because we're widening our stop loss. We're doing this to brace for the volatility. Like I said earlier, 30, 100-point move on the S&P or the 500-point on the NASDAQ is not uncommon. So with this, we still have to maintain a 2-to-1 or better risk to reward ratio. We have to widen our stop loss, keep our risk consistent. What this is going to make us do is lower our position size. Very key. We are adjusting our size relative to the risk. Let's say our average risk is $100. Now let's act like we are longing a stock, and this doesn't matter the instrument, at $8. And this is pre-Trump market. This is pre all the volatility. We're long a stock at $8 and we are going for a $16 target. What this gives us is if our target is right, we're going to make $8 per share. Now, if our stop loss hits, our stop loss is placed at $6. This means we're going to lose $2 per share. If our risk is around $100, what this enables us to do is trade this position with 50 contracts or 50 shares or 50 lots, because 50 times $2 a share is going to give us a $100 loss if our stop loss hits, and 50 times $8 in profit is going to give us a $400 profit with only $100 worth of risk if we were to trade with 50 shares. Now, a 2-point stop loss, and now we can relate this to the S&P 500, a 2-point stop loss, 3-point, 4-point stop loss in the current market is way too tight of a stop loss. As I said earlier, it's not uncommon for the market to move up 20, 30 points in a few seconds or a few minutes. So in the market, a wider stop loss is needed. Let's now act like our stop loss is at $4. What this now means is our total stop loss from entry is $4 away. If we're long at $8, our stop loss is $4. That's $4 worth of risk. It would not make sense for us to trade with our 50 contracts because now 50 times $4 worth of a stop loss is a $200 loss. We are now increasing our risk just by widening our stop loss, which is not something any trader should do. Now what we would do is adjust our position size to 25 contracts. 25 times 4 is now still $100. And now maybe since the volatility is there, let's now place our target at, call it $20. $12 a share times 25 contracts is still going to give us a profit of $250. See how we lowered our position size relative to the risk. And this is needed in the current market. So now let's show actual trades that I've taken and put these concepts to work. So this is a trade that I took on March 6th. This was an $18,000 profit. I traded 20 S&P 500 contracts. my risk to reward was about a 4-to-1, and I was risking $4,700 on this trade, and I traded 20 contracts. Now, this is the offensive example because when we're actually right on the market's direction, if we're to look at my entry here, I got long around the 57.91s. Being long down here, in 15 minutes time, the market rallied 30 points, and my last exit was at 58.20, giving me a 30-point profit on the S&P. 30 points for me, based on how I trade, 30, 40, 50 points, is a large move, and this is not very rare in the current market conditions. Even if we shorted, let's just say the high up here, in 10 minutes, the market dropped 30 points. Even if we shorted this high, an hour, 45 minutes later, the market dropped 80 points to the downside. So the larger moves are there, but it's just timing the market correctly. I am personally more of a defensive trader. The same exact day, I took a larger loss than anticipated. So my average stop loss in previous market conditions is 2-3 points away, sometimes even less than that because of how well I confirm my entries. And my average risk is around $4,500 on average. The previous trade that I took on this was planned to be a $4,300 loss. But on the defensive side, I lost more than anticipated. So pulling up this chart, I was long down here. My stop loss was above this high up here. And unfortunately, this candle on the 1-minute chart right here was about a 20-point range from the low to high in a 1-minute period. So in 1 minute, this candle moved in a 20-point range. And I use mental stop losses, so when we're wrong, I unfortunately got a little slippage, and my loss, which I exited at 57.69, was 2 points higher than my planned risk. My stop loss was at the 67s. I unfortunately had to exit at the 69s. So because of these large moves, when we're wrong, if we're playing defense, sometimes it's a little difficult if you don't use hard orders to get out. And what you see here is my position size on this trade was 25 contracts because my stop loss was only 4 points away. Versus on the previous trade, I traded 20 contracts because my stop loss was 5.5 points away. So you see how I adjust my size and make my risk consistent. On offense, when we're right, it pays well. On defense, if we protect ourselves best as possible, if you obviously don't have slippage like this example, our losses are going to be the same even when we size down on the position because we have a wider stop loss. I posted this in the Discord. Size down, keep your risk consistent. The wider stop loss needs to be used to brace for this volatility. Having a 2-3 point stop loss is not effective in this volatility. I'm sure many traders have the market direction correct, but are just simply mistiming the move. Widen the stop loss, lower the position size will help remain in a trade with this volatility. Now, I also want to say the stop loss has to be placed at where you're wrong on the analysis. Don't just place your stop loss at 4 or 5 points, 2 or 3 points, 9 or 10 points. Don't do that. The stop loss has to be placed where your analysis is incorrect. And every trade is going to be different. Some trades it might be 5 points away. Some trades it might be 10 points away. But regardless of how far the stop loss is and how different it is on a trade-by-trade basis, our risk will be the same on a trade-by-trade basis. And the only way to do this is adjusting our size. And in this market with the volatility, there's going to be more volatility in our minds when there's more volatility in the market because we're going to see the market, move up, move down. We're going to want to get in it. We're going to want to get out of it. We're going to take a big win. We're going to take a big loss. And there's just a lot of up and down roller coaster emotions in our mind. And one thing that will help keep our emotions under control is reducing our position size to brace for this volatility. Look at this trade that I took on the S&P. This was 20 contracts. My risk, again, is going to be around the same, $4,700. It was a 3.3 to 1 risk to reward ratio. Now, normally, how I confirm my setups, my stop losses usually get placed at the low that the market forms after it bounces. This is what I mean, and this is going to be the validation point to everything that I've explained here, is this, to me, would be a normal stop loss. If my entry is here, my normal stop loss would be below this low. But to brace for this volatility, I adjust and widen my stop loss to brace for moves like this, to brace for moves like this, to brace for the random volume to come in right here and the market to move up 15 points in a 2-minute period. I widened my stop loss to brace for this. So with an entry point right here, a normal stop loss would be below this low, and I normally would have gotten stopped out of this trade. But this trade ended in a $16,000 profit. I got 16 points worth of profit. I lowered my size to widen my stop loss. My stop loss on this trade was around 5.5 points, and eventually when the market rallied, I was able to hold on this trade because, again, my risk was consistent with my normal trades. If I traded this with, let's just say, larger size and didn't adjust, this would have been such a larger loss if I did stop out there. But because I lowered my size, widened my stop loss, I was able to sell at the high for a profitable trade, whereas I would normally get out here for a loss. But because of the market, because of the volatility, and because of the current market conditions, I adjust according to what the market is presenting to me and providing. So this is so crucial. This is so key. And if you implement this in your trading, I'm so confident you'll see a difference in your trading. You'll start staying in positions you should be in. You won't exit trades that you should not be out of. And your losses will be around the same dollar amount, which if you maintain a good risk to reward ratio, the wins when you are right are just going to compound compared to your losses. So I'm going to end the video on that note. If you learned anything from this, if you have any questions, comments, let me know down below. If you're new to my channel, hit that subscribe button. And also, I would really recommend you to follow me on my Instagram. Link for this will be in the description below. But I'm ending it. Peace out.